Hello, and welcome to The Advantage Investor, a Raymond James Limited podcast, a podcast that provides perspective for Canadian investors who want to remain knowledgeable, informed, and focused on long-term success. We are recording this on April 11th, 2024. I'm Chris Cooksey from the Raymond James Corporate Communication and Marketing Department, and today Sonya Dolguina Manager Tax Consulting joins the podcast to talk tax, including new tax accounts and laws, cross-border tax implications, as well as some general tax planning tips. Sonya, no shock to you, but it's tax season, so welcome to the podcast. I hope you're doing well today.
Thank you so much for having me. I'm doing great.
Excellent to hear. Obviously, a lot to get to when it comes to tax, and we'll jump right in then. So when it comes to new tax accounts and laws, the big new account, I think, would be the first home savings account. And we do have an episode in the archive on first home savings account from a financial planning perspective. So it'll be great to get your information on the tax side of this. So maybe just a quick overview on what it is and how it can be opened, etc.
Absolutely. So first home savings account, FHSA, it's a great account. Essentially, the way it works is you make contributions to the account of a maximum of $8,000 per year, and then you get a deduction on your tax return for the amount of the contribution, and any investments that you have within the account essentially grow tax-free. And the great thing is, as long as you make a withdrawal from the account to buy a qualifying home in your first home, then it's a tax-free withdrawal. So it really is the best of both worlds of a TFSA and an RRSP, because you get the deduction, but you don't get taxed when you take it out as long as it's for a qualifying withdrawal.
Okay. Now, I think the first home savings account is a little bit of a misnomer. I don't think it has to be technically your first home, but it's the government, so I'm sure there's rules, and maybe we can just go over those.
Yeah, absolutely. So we get a lot of questions about individuals saying, hey, this is their situation. Can they open an FHSA? So a lot of what we see are rental properties. So technically the rules say in order to be considered a first-time homeowner for the purposes of opening this FHSA account, you could not have owned a home that you lived in as your principal residence for the current or previous 4 years. So someone who perhaps still owns a home that they rent out, but they haven't lived in it as their principal residence for the last 4 years, they could still open an FHSA account and make contributions. Or maybe they used to own a home and they owned it, 5 years ago, and then they haven't owned a home since that they've lived in as their principal residence. They could still open an FHSA.
All right. Now, just say I'm a really nice guy and I want to, provide a down payment for my children. How can I support an adult child with the FHSA? Is that even possible?
Yeah, they definitely just roll off the tip of your tongue like TFSA does. So yes, absolutely. So this is a great tool. You're in Toronto, I'm in Vancouver. Homes are very, very expensive. It's almost impossible to buy a home if you're a young individual without a bit of help from mom and dad. So definitely I would suggest that individuals can gift funds to their children up to $8,000 per year in order to contribute to the FHSA, and the child will get a tax deduction, and none of that income within the account is going to be attributed back to the parent. Now, some tips: perhaps your child won't get much use out of a tax deduction right now. Maybe they're still in university, they aren't in much of a high tax bracket. They could actually defer the deduction until a future year, so they could still make a contribution, but maybe take that deduction, carry it forward indefinitely, and they could take that deduction when they'll be in a higher tax bracket and we'll get more use out of it.
Okay, that makes sense. Now, in terms of tax planning, we have the TFSA, obviously, that I think probably more than one person has used to save for a home. But now we have the first home savings account, as you know. Can they work together, or does it make sense to withdraw from the TFSA? Maybe just a little bit of your expertise here, please.
Absolutely. So the great thing about withdrawing from a TFSA is any funds that you withdraw, you get that contribution room back the following year, and any withdrawals are, of course, tax-free. So when it might make sense to take money out of a TFSA to contribute to an FHSA is if you perhaps have limited funds for investing and you don't have, the maximum $8,000 to contribute to the FHSA. You could take money out of the TFSA. Just be careful not to over contribute, and you may have to wait until the following year to put money back into the TFSA. So a few other tips with the FHSA. So you actually have to open the account in order to start building contribution room. And you can carry forward contribution room up to $8,000 per year. So it's not like the TFSA or RRSP where you actually don't need to open an account in order to build contribution room. With the FHSA, you do. Some other tips are you can only have an FHSA account open for a maximum of 15 years. So you kind of want to be a bit careful there. You could want to plan to purchase a home in the within 15 years. But if you don't, then there's actually no concern because you can roll that FHSA into an RRSP. As long as it's a direct transfer, it'll be tax-free. So it's essentially like bonus RRSP room, and you don't need to have RRSP contribution room to do so. So really, even if you don't plan to purchase a home, it still can make sense to use this FHSA. It's like a bonus RRSP, essentially.
That's very interesting, actually. I hadn't heard that one yet. So
yeah.
Always nice when the government allows these little loopholes here and there, I guess.
We don't get much, so.
Fair. So there's been some new tax laws in the last year or so and last budgets and whatnot. And at the federal side, as you mentioned, or on the federal side, you mentioned the cost of homes. And I think one of the ways they are trying to prevent that is, the flipping of real estate and that sort of thing. So maybe you can just discuss some of the laws around flipping your assets that way.
Yes, absolutely. So essentially kind of going back before these anti-flipping rules were in place, if you purchased a home and you lived in it as your principal residence, even if it was your principal residence for a few months, you could sell it and any capital gain could be tax-free because as long as it was your principal residence for that year. So, the homes in Vancouver, Toronto, a few months, you could get some very big gains. So, the government's really trying to discourage this sort of speculative behavior and flipping of homes. So they have this new rule, and this is for any property dispositions after January 1st, 2023. Essentially, any gain from a disposition of a housing unit that you held for less than a year is deemed to be business income. And with business income, 100% of gains are taxable. It's not a capital gain where only 50% of gains are taxable, and the principal residence exemption is not allowed. So essentially, let's say I buy a home for $500,000 and then I sell it within 9 months for $600,000. That's $100,000 added to income, taxed at my top marginal rate. There's no benefit of the principal residence exemption, even if I lived in it. Now, there are a few exceptions, such as in the case of death, disability, separation, work relocation. And then on top of that, if I sell a home and maybe I made a loss and it was a flipped property, I held it for less than a year, the losses are disallowed. So really, they are trying to discourage property flipping. The government wants you to purchase a home to live in it for the long term.
All right. Now, in terms of new laws, there's a multi-generational home renovation tax credit, which I'm sure you're very familiar with the details. So if you could share those, that would be fantastic.
Absolutely. So in order to, help alleviate the issues with housing, the government announced this new tax credit. So essentially, if you use funds to renovate your home to build a secondary unit so that a relative of yours who is age 65 or older, or if they're 18 or older but they qualify for the disability tax credit, you're essentially going to get a tax credit of 15% of qualifying expenditures up to $50,000 of costs that you incurred in order to build a secondary suite in your home. So a secondary suite does need to have, like a separate entrance, separate kitchen. So it does really need to be a second suite there. And a few questions that we've got last time I've talked about this credit is, well, what if I just build a basement suite? Does that individual really have to move in? What if they didn't end up moving into the unit? Well, the rules do say that the qualifying individual does need to reside or intend to reside in that secondary suite within 12 months after the renovation period ends in order to qualify for the credit. So again, that's up to $50,000 of costs will qualify for 15% federal tax credit to build that secondary suite.
Okay. Now let's move, literally, I guess, when we're coming to cross-border situations. Obviously, a lot of North Americans work either in Canada or from Canada, work in the U.S., move to Canada, whatever. So let's talk about the tax implications of moving to Canada. Obviously, with whatever 401ks and the other U.S. Type retirement accounts, for instance, from a previous employer. What are those implications?
Yeah, absolutely. So when it comes to U.S. retirement accounts, generally speaking, the Canadian rules will mirror the U.S. rules when it comes to traditional IRAs and 401ks, where it's tax deferred within that account from a U.S. perspective, and Canada will mirror that same tax treatment. So you don't have to worry about any income that's within the traditional IRA or 401k being taxable in Canada. So it's really when there's withdrawals from the account that it's considered taxable from both the U.S. and Canadian perspective, as long as you're a tax resident in Canada. And then you would claim a foreign tax credit to alleviate from double taxation. Now, some individuals have a Roth IRA, which you could say is a bit equivalent to our TFSA. So that's treated a bit differently. You can make that account tax-free from a Canadian perspective, but individuals need to know that they have to file an election with the CRA in with the tax return of the first year they become Canadian tax residents to get that account also tax-free, which you'd want to do. Some individuals will, move to Canada, and then the financial institution where their 401k or traditional IRA is held in will say, hey, we can't help you anymore. We can't hold your account because you're no longer in the U.S. As you know, that's where Raymond James can come in and help with our platform and roll those accounts into a IRA held with Raymond James. And that should be a tax-free transaction as well. So you definitely have to get some tax advice on that, but we could definitely help. Otherwise, some things to consider are investments that are held in non-registered accounts, so just regular investments. When someone moves to Canada, they get a bump up in their cost basis. So sometimes you get individuals to say, hey, I have a bunch of investments. Should I sell them all before I move to Canada? So generally, if they're in a gain position, there really necessarily isn't a requirement to do so, because from a Canadian perspective, your cost basis is going to be the fair market value of those investments at the time you became a Canadian tax resident. So if you sell those investments afterwards as a Canadian tax resident, Canada only has the right to tax you on the gain that accrued during your Canadian tax residency, not the gain that accrued, for the entire period that you held that investment.
Okay. Now, if we play the switch card and we go back the other way, what happens if you're moving out of Canada? What are some of those concerns?
So, a few things to consider. One is departure tax, or the deemed disposition of assets. So essentially, certain assets that you held, you're deemed to have sold those based on their fair market value as of the day that you ceased Canadian tax residency. But there's a number of exceptions. So one are the registered accounts. So things like RRSP, RIF, TFSA, RESP, also Canadian real estate. You're not deemed to have sold that. And generally the logic behind that is, even though you're going to be a non-resident, Canada will still have the right to tax you on those accounts going forward. So if you make withdrawals from a RRSP or a RIF as a non-resident, Canada will still have a withholding tax on that. And then also if you sell your Canadian home after ceasing Canadian residency, they could still tax those gains. Whereas investments that are in non-registered accounts, essentially, this departure tax is going to be a capital gain based on the unrealized gain at the time you cease Canadian tax residency. And 50% of capital gains are taxable. And then that's kind of your final tax to Canada. That's your final goodbyes. You're paying that tax. And then going forward, when you sell those non-registered investments, when you're a resident of the home country, Canada should no longer have a right to tax those capital gains. They kind of already wrapped up the taxation based on whatever gain happened before you ceased residency. Now, what I would definitely recommend is to talk to a cross-border tax accountant and really understand how your new home country will tax all of your accounts, your non-registered accounts and your retirement accounts. So, for example, let's say you move to a country where if you sell your investments that are in non-registered accounts when you're a resident of that country will tax the entire gain. Now, that would be not a great situation because that would result in double taxation. In that situation, it may make sense to just liquidate your accounts and non-registered assets before you cease Canadian tax residency, just to avoid the double taxation, and then just invest in accounts in that new country.
Okay, that makes sense. Now let's just talk a couple general tax planning things, and then I'll let you get on with your day. I really appreciate your time. Income splitting with a spouse. What do people need to be aware? Obviously, people are in situations where one spouse makes more than the other, and might be a great way to reduce your tax bill. So how can people go about that?
So, common misconception that we see is, hey, I'm in the highest tax bracket. My spouse isn't working, or they're not working much. I'm just gonna split my investment income with them for capital gains, dividends, interest. Just put them on the title of the joint account. Now, lots of people do that, but they need to be aware of something called the spousal attribution rules, where you need to look at who originally earned the money to fund that investment, and any income that's generated from that investment is generally attributed back to that original spouse. So just by adding a spouse to a joint account and perhaps having both names on the T5 slips, that doesn't necessarily mean that the proper tax rules say that you could split the income 50-50. Now, there are some income splitting techniques that you could still employ. One is having a spousal loan. So you can set up a loan where you could loan your spouse money so they can invest, and then any investments from that loaned capital will be taxed in that spouse's name. But in order to actually do this, then you need to charge interest on that loan. And right now, the CRA prescribed rate on those interest as of the day we're recording this podcast is 6%. So really, unless your investments are going to generate a return that's higher than 6%, it may or may not be worth doing the spousal loan. And back when prescribed rates were 1% a couple of years ago, the spousal loan would have been great, but maybe hold off until the rates come down a little bit in order to see if a spousal loan might make sense. Other techniques are spousal RRSPs, where if you believe at retirement, your spouse is going to be in a lower tax bracket than you, then you can contribute to your spouse's RRSP and you use your own contribution room and you get the deduction. So you get the deduction at the higher marginal rate. And then when it turns into a spousal RIF, generally speaking, the income will be taxed in the spouse's name. And then lastly, another income splitting technique is gifting funds to your spouse so they can contribute to a TFSA. So, many Canadians have not maxed out their TFSA. So definitely a good idea. Kind of a simple income splitting technique is to just gift them funds so they invest in their TFSA, and then it'll all just be tax-free for everyone.
All righty. And let's just finish off with, a popular thing to do to help charities and whatnot is to donate stocks rather than cash. So how do you maximize those benefits?
Yeah, exactly. So, generally speaking, if I were to sell some investments and donate the cash proceeds, then the way it would work is I would have a capital gain, and 50% of capital gains are taxable at my top marginal rate. And then whatever cash I donate to the charity, I'll get a charitable donation tax credit. Now, a way to actually get a better tax result is to donate the stocks directly to the charity. So you may have to work together with the charity to see if they could do that, or you could work and talk to your advisor about the Raymond James Foundation. But generally speaking, if you donate stocks directly, then there's a 0% inclusion on the capital gains. So if you have stocks that have increased in value quite a bit, then there's 0% inclusion, and you get the donation tax credit based on the total fair market value of the stocks that you donated. So it generally could result in a much better result in terms of tax savings when you donate stocks in a gain position rather than donating cash.
All right. Well, first of all, I'd like to, again, thank you for taking the time today, Sonya. A lot of great information for people to digest there. And I hope you will come back and join us again when we have more tax talk to go over.
Absolutely. The federal budget is coming out in about a week, so I'm sure there'll be lots to digest and talk about. Well, thank you so much for having me, Chris. It was great.
Thank you very much. Reach out to us at advantageinvestorpod@raymondjames.ca. Subscribe to The Advantage Investor on Apple, Spotify, or wherever you get your podcasts. Please contact your advisor with any questions you have. On behalf of Raymond James and The Advantage Investor, thank you for taking the time to listen today. Until next time, stay well. This podcast is for informational purposes only. Statistics and factual data and other information are from sources Raymond James Limited believes to be reliable, but their accuracy cannot be guaranteed. Information is furnished on the basis and understanding that Raymond James Limited is to be under no liability whatsoever in respect thereof. It is provided as a general source of information and should not be construed as an offer or solicitation for the sale or purchase of any product and should not be considered tax advice. Raymond James advisors are not tax advisors, and we recommend that clients seek independent advice from a professional advisor on tax-related matters. Securities-related products and services are offered through Raymond James Limited, member of the Canadian Investor Protection Fund. Insurance products and services are offered through Raymond James Financial Planning Limited, which is not a member of Canadian Investor Protection Fund.